Are you only investing because everyone around you is investing? Do you fear missing out on a great opportunity if you don't? That's what FOMO investing is all about. And if fear is guiding your decision making, you should change that, because FOMO investing can play a cruel joke on you. Today, we're going to talk about why FOMO investments are dangerous and how you can avoid falling into the trap. Meet John. He doesn't know much about investing, but he is sure as hell it's profitable. Why? Because his friends, neighbors, and colleagues invest. Even his dog will invest if it had hands instead of paws. It sounds like everyone around him is chasing success. Obviously, John would not be an exception. So he starts investing immediately in everything he hears about on Twitter, Reddit, in his investing communities, and from his friends who have some insider info. But this might be the worst decision of his life. Why? Because FOMO investing hides many dangers. It assumes that everyone knows how to invest and ignores the fundamentals that need to be considered for success. It risks losing your money because of spoofing. We'll come back to this later. It leads to overtrading. It ignores the fact that high volatility can lead to low liquidity overnight. It tempts you to choose short-term wins over long-term success. It allows stress to influence your decisions. I know all those dangers might sound confusing, but we will go through each and one of them in detail to help you be mindful of your investments. So, the first danger is making irrational decisions by assuming that everyone around knows how to invest. Imagine John knows almost nothing about investing, but he reads the news online, including social media. By the way, Facebook is the social media platform that creates the most FOMO effects. Why? Because of what it shows the users and how it presents information. So every day, John sees impressive stories like Frank's success story of how he invested $1,000 in real estate a year ago, and today his income has grown 5 times. Mary's track record of investing in the most prominent tech companies like Apple, Amazon, and Tesla. And of course, Paul bragging about buying a villa near the Atlantic Ocean, all due to his crypto investments. A lot of these stories could be scams, but what goes through John's head when he reads it? He thinks, why can't they do it and I can't? I should start investing. But how? I'm gonna invest in the big names and I need to start right now. And then he takes action. John gets hyped up and buys shares of mainstream companies people talk about. But he has no real strategy, and this will inevitably lead to a disaster. But what should John do instead? Well, first of all, take a deep breath. You need to stop thinking of everyone on the internet as an expert in investing. Unfortunately, even real experts can sometimes be wrong. You should always take people's opinion with a grain of salt. And I know, it's kind of ironic because this is a YouTube channel. However, what makes us different is that we're not telling you what next big deal you should go and buy. Instead, what we do is to share the information to help you make informed decisions. Big difference. Now, back to the video. Next, you should do research from different angles. Use various sources of information and remember to check reviews. Without this data, you will be blind in the world of investing. Then, develop an investment strategy. To do this, ask yourself questions like, what am I going to invest in? Why is it the best option? What are the downsides of this option? How do I want to invest? How much am I willing to invest? How often am I ready to do it? How much profit will I make in 1 year, 5 years, and 10 years? So John didn't do any research, and he is now at risk of losing money because of spoofing, something that occurs when a scam is presented as the real deal. The main goal is to extract money from victims. The scheme is very common in crypto. In this case, let's say John was offered to buy a hyped crypto, but no one told him about the low liquidity, meaning that it is hard to convert it back to cash. And of course, John doesn't know that because he didn't do his proper research. Then, when he goes to forums, he sees thousands of people saying that this new crypto will explode. but it turns out that it's nothing more than just bots writing it. Let's remember that any market can be manipulated in some way, but to significantly influence, for example, the S&P 500, you need billions of dollars. This is not the case with cryptocurrencies with low trading volumes. Sometimes even a person with $100,000 can significantly influence the price of buying or selling their assets. So it's easy to create an illusion of optimism around cryptos. Traders do this by placing large buy or sell orders with no intention of ever proceeding with them. When large investors do this, they trick others into buying or selling, changing the price of the crypto as a result. But let's get back to John. He thought it was too complicated to do fundamental research and relied on the advice of people he knew. It seemed like a logical thing to do. Still, this is a dangerous strategy. By doing so, John runs the risk of losing money and time. Plus, because of his negative experience, he might give up investing in the future. The truth is that you don't need to be an economist to start investing. All you need is to be attentive and analyze. Here are a few tips. First, decide what you will invest in. It can be anything: funds, stock, real estate, treasuries, etc. Start with one thing. Don't rush to jump into something popular. Check it out a few times. Next, do a thorough research. Understand the basic concepts and how the chosen market works. Read about the pitfalls and benefits you can get. Also, consider using professional services. Most likely, you will need the help of a broker or an agent. But before you do, check their reputation and reviews. For example, you can ask the broker for their license and double check it online. Next, read the reviews. Use a variety of sources. These could be social media platforms or comments below news articles. The more data you analyze, the more informed your decisions will be. Try to find polarized opinions to get a full picture. Now, is it enough to just create an investment strategy and do good research? No, it's not. Because you have to know about the third danger of FOMO investments: engaging in overtrading. What does that mean? FOMO can lead investors to trade more often than necessary. This often leads to higher transaction costs and poor decision making. But it isn't just that. Overtrading has other negative consequences as well. The first one is the increasing transaction costs. Every trade involves costs such as brokerage fees, commissions, and in some cases, taxes. That's why overtrading leads to higher expenses. Even fees and commissions alone can reduce your profit and increase losses. Another dark side of overtrading is capital gain taxes. Frequent trading can lead to short-term capital gains, but these are usually taxed at a higher rate than long-term ones. For example, long-term capital gains are often taxed at 15% or lower. Meanwhile, short-term capital gains are taxed at ordinary income and reach 37%. But there's more to that. Overtrading is also about making emotional decisions. Emotions often fuel excessive trading based on the fear of missing out. As a result, investors can make poor choices and get worse results. And these emotional decisions can lead you to neglect your investment strategy, which is another issue. Overtrading can cause you to lose sight of your overall investment strategy and goals instead of building a well-thought-out portfolio. You might end up with desperate investments made in a want. And let's not forget that the time and energy spent on excessive trading could be used for more productive activities. For example, research and education to make more informed decisions in the future. Okay, that's all reasonable, but what should you do instead? First, you need to establish clear trading rules. Set specific criteria for investing and exiting trades. These can target profit levels and stop-loss limits. Follow these rules and avoid impulsive trades. Second, create a trading plan. A plan is always crucial, but when it comes to investing, the most important things you have to consider are your goals and risk tolerance, because your strategies will be very different when you're in your 20s and your 60s. The next thing you can do is limit the number of trades. What I mean is limiting the number of trades you can make during a certain period. For example, in a day, a week, or month. This helps reduce the urge to trade too much and helps you stick to your strategy. Next, set aside some time to analyze the market. Sometimes we just need to take a look at our portfolios from a different perspective. And it's hard to do that when you're too stressed with managing what you have. So schedule some time to reassess everything and avoid constantly checking prices or news, which can lead to emotional trading. Another helpful thing you can do is keep a trading journal. Here, you should document every trade, including the logic behind it and its outcome. Regularly reviewing this log can help you identify patterns of overtrading and understand the triggers behind them, whether it was some panic on the news or your friend telling you something. And most importantly, remember to keep educating yourself. You can never know enough. So when you get a moment, study market dynamics and trading strategies. This way, you will improve your decision-making process. So that was overtrading. Now, the fourth danger of FOMO investment is not considering that high volatility can lead to low liquidity. Now, let's see what that means and why it's dangerous. For example, many investors who rush to buy an asset in a panic can cause its prices to rise. But when many people start selling it at once, the prices can drop too much and too fast. FOMO can even contribute to market bubbles. When many investors buy an asset out of fear of losing, they can drive the prices much higher than its real value. Eventually, this leads either to a market correction or a collapse. And to make matters worse, people can invest in some doubtful things that seem cool at the time. Like crypto meme coins. They got pretty crazy a few years ago, but obviously most, if not all of them, have serious liquidity issues, meaning that as soon as the trend goes away, no one needs those meme coins. So selling them fast and for a good price, it's almost impossible. But how can you avoid falling into these traps? First of all, stay informed. Follow market news and trends, but don't be influenced by the short-term market noise. Another essential thing is to keep a long-term perspective. Volatility is a normal part of investing, but keeping a long-term perspective in mind can help you avoid making impulsive decisions. Next, choose diversification. Your portfolio can include different assets like stocks, bonds, real estate, and also multiple industries or geographic regions. Why? Diversification can reduce risk because some investments react differently to the same event. In the end, the more you diversify your investment portfolio, the more secure your money will be. As for your portfolio, you should also review and rebalance it regularly. Remember that things change, so you might want to mix and match your assets every here and there. Besides, your goals and priorities can also change. Maybe you want to accept a higher risk now, but you might change your mind in the future with a family and kids or even retirement. But whatever you do with your portfolio, you should have cash reserves. I know I sound like a broken record at this point because I say this in almost all my videos, but having cash reserves is very helpful in periods of high volatility. Plus, you feel more confident and less stressed because of sudden changes. As you see, long-term goals help survive volatility, but some investors do not pay enough attention to that. As a result, they face the fifth danger of FOMO investments, which is choosing short-term wins. And here are the negative effects of this approach. Limited diversification. Investors who prefer short-term planning often don't diversify their portfolios appropriately. Instead, they concentrate on an asset that provides quick returns. That's why the strategy is risky. Another negative effect of a short-term investment strategy is trying to guess the right time. Determining when to enter the market in the short term is extremely difficult. Investors often try to predict short-term price movements, but even experienced pros face difficulties with this. Then comes the lack of time to accumulate gains. One of the key benefits of long-term investing is the power of compounding, when your gains generate additional income over time. Investors that have short-term plans don't have time for compounding to work. How to avoid this? The main rule is simple. Always set long-term goals, because this way you are more resistant to risk and are able to get more profit. But as we saw, John started investing without knowing all of that, and as a result, he faced the next FOMO investment danger, which is emotional stress. When people exposed to the FOMO effect were asked what they felt, 39% of them admitted to feel envy. Besides, a common thing is to feel anxious or depressed when others have better investing results. But here's the thing, not all of the people you see successful are the real deal. Plus, very few talk about their failures. But when it comes to success, people scream about it. So stop believing everything you see online and try to be as critical and selective as possible. Don't get obsessed. We can't really influence the market, so for investing, less is often more. Avoid negative environments like communities or sources of information that make you feel bad. Instead, subscribe to those who can inspire you to take action and help you with advice on how to do better. And finally, never give up. Even if you don't succeed right away, don't be discouraged. This is how you get valuable experience. Theodore Roosevelt once said, "The only man who makes no mistakes is the man who never does anything." What about you? Have you ever experienced the FOMO effect? Share your experience down in the comment section below. See you in the next video. Bye-bye.